do SPIVA scorecard results look like once you factor in taxes? Hello, my name is Ganti from S&P DJI's Index Investment Strategy team. And joining me today is my colleague Joe Nelesen to talk about the results of the new SPIVA After-Tax Scorecard. Joe, thank you so much for being here today.
Thanks, Anu. It's always good to talk.
So it's interesting because we've produced SPIVA in the U.S. for more than 20 years now, and we've expanded it across regions to Europe, Latin America, Asia, and we've learned so much as we've expanded the SPIVA franchise and across asset classes from equities to fixed income. And the key goal of SPIVA, which stands for S&P Indices versus Active, is really to serve as an independent barometer, a yardstick to understand how our active managers doing. So now in the latest evolution, we factor in taxes. So I'd love to get your thoughts on what the SPIVA After-Tax Scorecard is.
Sure. Well, as you mentioned, it's an extension now to factor in the tax experience, really to reflect that many investors hold mutual funds in taxable accounts, and this is a real impact on their performance. So what we've done is taken these results, normally the standard with SPIVA and with any reporting of active fund returns, is to assume that dividend distributions to the investor are reinvested 100%, and that factors into performance. However, the real world shows us that in many cases, when there's a distribution of a capital gain, a dividend, etc., to an investor, that investor has to pay taxes on those distributions at the end of the year. That portion is taken out before those distributions are reinvested. That impacts performance, taking the returns lower. Now, what we did is important. We did that for active funds, which follows a standard set by the SEC back in 2001. And in fact, active funds have had to report post-tax returns for quite some time. We took the same approach, though, and applied it to indexes, reflecting what an index fund would look like after taxes, and compare the results.
That's great. And you know, in SPIVA US, we look at performance net of fees. We also have our SPIVA Institutional Scorecard, where we show performance gross of fees and net of fees. And over the long term, we see that the results are very negligible, very consistent across the board. So now if you think about it, we've got performance, we've got fees, and now we layer in taxes. So I'd love to understand from your viewpoint, what was the need now to create this after-tax scorecard?
Sure, I think the need has been there for quite some time. Right? Taxes on distributions is not a new thing. And in fact, it's every year we hear about the phenomenon of investors having a capital gain distributed from their active fund, which is something can be unpleasant when they consider they have to pay taxes on the gain if it's large. I think the year of 2022 was really kind of when the dam breaks, so to speak, where many funds were in negative territory. The market itself was down 18% in the S&P 500, and you had investors who were holding funds that had declined and yet had a large distribution because of a lot of the trading activity that took place during the course of the year. And so the call was coming from investors, from partners of all types, to show an after-tax version of performance. We finally put the resources together to do that for 2022.
And you know, the key message from SPIVA is that most active managers underperform most of the time. That's the key message. We see this all around the world. We see this across asset classes, and it's just so powerful to see that message, right? And once we factor in taxes, what would you say is the key message of this new scorecard?
The key message is that taxes seem to impact, on average, active funds to a greater degree than they do indices. For example, we looked at the all-domestic U.S. funds category, right? A little over 2,000 funds at the beginning of a 3-year period, and about 400 plus of those funds outperformed. So you had about a 79% underperformance rate. Now, when you factor in taxes, you find that a lot of those outperformers of those 400, in fact, about 50% of them, were just barely above the benchmark. After taxes adjust performance, they fall below. And that underperformance rate increases from 79% to 89%. Another key data point we found is that when you look at the performance difference of a benchmark versus the median active fund, you find annually about 40 basis points lower for the index based on the tax on dividends. Compared to active funds, the median funds are down anywhere from 1% to 2% per year in their returns, which has a much bigger effect on performance. And that explains why a lot of these underperformance rates increase significantly after taxes are added in.
You know, and every year that we produce SPIVA, we learn so much about active manager conditions. And if you think about conditions that are potentially beneficial for active managers, a few to name are, higher dispersion, for example, the underperformance of the mega caps, a down market because perhaps active managers can go to cash. All of that came together in 2022, and we saw that only 51% of large cap active managers underperformed the S&P 500. So it was interesting to see that amalgamation together. It was the best year since 2009, the fourth best year in our database. So now that we factor in taxes, what would you say that means for active managers?
I'd say it means it's even more difficult the closer we get to looking at what an investor truly experiences to find a manager that outperforms. As you mentioned before, we've looked net of fees, gross of fees. We've done this a lot of different ways. We find there are many frictions in addition to the difficulty of finding outperforming stocks year after year. But you factor in fees and now you factor in taxes as well, and you find that the task of finding a consistent outperformer is frankly close to impossible.
No, that's fascinating to see, and we look forward to seeing the results and digesting them. And thank you so much for this exciting new analysis, and we're looking forward to reading it.
Indeed, and this the first, but hopefully not the last. You'll see more.
Thank you again, Joe. And for more information on SPIVA and to get the latest SPIVA After-Tax Scorecard, please visit us at the link below.